Welcome back to the Stevens Group Podcast, the show where we break down everything real estate, from buying and selling to investing and financing. Today, we're diving into one of the most important and sometimes confusing parts of buying a home: the mortgage process. Whether you're a first-time home buyer, seasoned homeowner, or just curious about how lending really works, this episode is packed with insights you don't want to miss. I'm joined today with John Noldan, the Executive Vice President of Mortgage Lending with Rate. 25 years of experience in helping clients navigate the loan process. We're going to talk about the biggest mistakes that buyers make, how to get financially prepared, what loan options are out there, and where interest rates might be headed. So if you're ever wondered what lenders look for, how to avoid being house poor, or how to make smarter decisions when borrowing, you're in the right place. Let's jump in. John Noldan, thank you so much for joining us today.
Of course, man.
So a quick intro about you. Tell us a little bit about how you got started in the mortgage industry, how long you've been in the business.
Yeah, I've been in the business for over 20 years now. Almost 24 years. So started in 2000, right around 2000. Poli-sci pre-law major, Benedictine. Obviously not really using that right now. I was in politics before I got into business. My uncle was Jim Ryan, who's the Attorney General. He ran for governor. We lost for governor. And I was 22 years old, so I just started bartending. I didn't know what I really wanted to get into. And one of my really good buddies' dad owned one of the biggest real estate companies in DuPage at the time. And we always got along really well. He said, "Why don't you get into doing mortgages?" I'm like, "I don't even know what they are," because I was so young. I was renting at the time. And then I dove in. And I at the time, I jumped in there as a real estate office. I was an in-house lender there. And I built a ton of relationships. And ever since then, it's just blossomed. I love it.
Yeah. Well, you and I have done some deals together.
Yeah.
And I am not a first-time home buyer, but let's say I was. Can you walk me through the lending process from start to finish as if I was a first-time home buyer? Yeah.
So first-time home buyers, with technology right now, it's gotten a lot easier from when it was 20 years ago or even 10 years ago. Most people opt now to do online application, which we offer at Rate. It's a very good, easy thing. You do it right on your phone, upload everything right from your phone too. But some people like doing it over the phone or meeting face-to-face, whatever they want to do. And at that point, I'm going to give them, after I have a small conversation, about 5 to 10 minutes, I'm going to ask them what type of documentation I'll need. It's all going to be depending on what type of job they have. So income documentation, pay stubs, income tax returns, W-2s, bank statements, last 2 months. I then answer all the questions that we all have to ask as lenders, and I run it through both Fannie Mae and Freddie Mac's automated system, and it's going to let us know what they're pre-approved up to. One thing that's very important, which I tell borrowers all the time, what you're pre-approved for and what you're comfortable spending are two totally different things. So let's back into a number so we can set up the search accordingly for you and your real estate agent.
Yeah. There's a lot of people that when I started working with some of these buyers, when I was in my 20s and 30s, somebody might be qualified for $600,000.
Yeah.
Great.
Yeah. Let's
buy something for $400,000 and go into a 15-year loan and pay it off in half the amount of time.
1,000%.
Let's start building wealth. Let's buy some investment property for the difference.
The best
in
way
what
to
you're
look
doing.
at it. A lot of these people, they go in trying to spend top dollar. You don't want to be eating ramen noodles. I mean, you want to enjoy your life and be able to buy other properties. Yeah.
It's not like being house poor.
No.
What are the biggest differences between a pre-qualification and a pre-approval?
So pre-qualification is kind of the thing of the past. I mean, I could do it right now with you, just sitting here, just talking about income and doing math in a calculator on my phone. It just kind of lets me know what you were pre-qualified for. There's no credit check. There's no verification of any documents. Yeah. So pre-approval, it's a full-blown thing what I just talked about before. Last 2 year's W-2s, last 30 days pay stubs, bank statements are running through the automated system. It's going to let us know what exactly you're pre-approved up to.
So if I was a first-time home buyer and I was just going to start, what type of documentation? You went over a little bit.
Yeah. I mean, so if you're a W-2 employee, not self-employed, most likely I won't even need the tax returns. So it'll be just your last 2 years W-2s. A lot of lenders only want one, but I always ask for 2 just because I want to take a look at all options available. Last 30 days pay stubs for sure. Last 2 months worth of bank statements and any other retirement accounts they have for a compensating factor for more reserves.
Okay. And what are the biggest mistakes that buyers are making when they first start their applying for a mortgage?
Not having their financials in order. Like they call and every credit card they have is maxed out. They got non-sufficient funds sometimes in their bank account. They don't even know what their scores are. They don't know what they want. So make sure you kind of have an idea what you want to do and be financially ready to do so.
Yeah.
You want to have your credit cards, at least 75% availability to get in those higher 700 credit scores. You want to have money saved in the bank. You want to make sure not only money saved in the bank, but reserves. So get yourself financially set to purchase that property instead of just calling up and trying to get pre-approved.
Yeah.
That's my advice.
There's so many times people are like, hey, I'm not going to, I'm in a rental until next May.
Right.
Now's the time to talk to a lender. Let's get pre-qualified.
Let's get going. Yeah, I mean, I've had people in my system for 2.5, 3 years.
Yeah.
And it doesn't matter because it's a click of a button to update that credit once you have a file. And you find that house, especially in a market like this, there's going to be 10 offers on it most likely. So you want to have your pre-approval ready. You don't want to be waiting for a lender to review everything. Get it all done now.
And there's so many times that buyers don't want to get their credit pulled.
Right.
What is the negative impact?
That's a great question. And this is how we know when people are serious or not. So at rate, and most all lenders now, you could do a soft inquiry and not have to do a full credit report. So the hesitation of, no, I don't want my credit pulled because it's going to hurt my score, that's nonsense now because we do a soft inquiry and still run it through Fannie and Freddie's system. Now, once you're under contract, we got to do a normal regular credit check, but there should be no hesitation to have your credit pulled anymore at all because it doesn't affect your score at all.
Thank you for touching on that because it's such a...
It's a biggest thing, but now you got listen, if you're serious or not, it's a soft inquiry. It does nothing to your credit report.
Yeah.
And we could run it through, and we pull all 3 bureaus with that too.
What are some quick wins to improve financials before applying?
For applying, credit card debt, that's a big one. If you've got a lot of maxed out credit cards, try to get them to at least 50% if you can. It's just your scores will get higher, and obviously your debt to income ratio will be better. Getting some money saved, and like I said before, money saved and money for reserves too, because you're buying a house, you still got to furnish a thing. God forbid something happens after you buy the house, you don't want to be tapping into retirement funds. Make sure you have some actual money saved up, and just making sure you got a good idea where your credit is. You want to make sure that your bills have all been paid on time. Like I said, you want to make sure you don't want to have non-sufficient funds. That ever happen in your bank account because underwriters hate that. So just make sure you're financially set.
Yeah. And agree. Needs to be done early in the process because I've had people where they found out they go to get pre-approved and they found out that there was identity theft or something like that.
Oh yeah, that
then it gets postponed. They're not going to be able to buy a house because
all the time.
It's going to be at least 6 months.
It happened to me twice this week already with clients.
Oh, geez.
And I had a client yesterday called me. He was trying to get pre-approved. He's currently in a bankruptcy. I'm like. So I mean, you got to kind of know what's going on before you get pre-approved.
So John, I know it's a myth, but do buyers really need 20% down?
No, it's a huge myth. As a first-time home buyer, it goes as low as 3% down. So, and mortgage insurance, which everyone was scared of, has gotten so very inexpensive now, even with 3% down. So it's not that big of a deal. And save your money, put your money in the bank. And at the end of the day, let's look at the payment. What you're going to be most comfortable with payment-wise, and back into that. Let's not liquidate all your cash because if you can put down 3% and then keep money in the bank for a later day or something you want to do with the house, great. You don't need to scrape 20% just to not have mortgage insurance. At the end of the day, it's what you're going to be comfortable with payment-wise.
And you could get rid of the mortgage insurance in the future anyway.
It falls off automatically at 78%. You definitely want to call the servicer once it gets to that point because they're not going to drop it right away. But at 78%, or if value is going up, when people always refinance, we get to use that new appraised value after 6 months after you buy. So say you did work on the home and the value's there, we could drop that mortgage insurance right away, depending on how much money you put down.
Awesome.
So 80% loan to value if you're buying, so 20% down, and then it falls off automatically at 78% if you currently have mortgage insurance.
Can you break down the different types of loans, FHA, VA, conventional loans, into simple terms? Yeah,
so simple. Fannie and Freddie, they're conventional loans, and right now the loan limit for them is $806,500 for the loan amount. So anything below that's going to be conventional financing if you're going with a Fannie and Freddie product. That's your most vanilla 30-year fixed. FHA, great product. A lot of first-time home buyers that don't have the best credit, they allow for 3.5% for a down payment. Rates are really low on FHA, even if you have a lower credit score. So if I got someone that's got a 640 credit score, and they're putting down 5%, the rates could be way better going FHA. The only thing with FHA is the mortgage insurance never falls off. But like I said, you can refinance out of that anytime too. So those are great products. And VA for our veterans, those are really good loans. It's 0% financing, so no money down. I had a guy that bought a place for 1.2 million. He didn't have to pay because of his eligibility. He did not have to pay property taxes or pay mortgage insurance or the funding fee. His payment was that of someone who had like a $400,000 house. It was for 1.2. So they're great loans, and they deserve them.
Yeah, absolutely.
And we don't charge. I don't charge the veterans anything for closing costs for their service.
Are you seeing any adjustable rate mortgages, and what are the biggest misconceptions about them?
Adjustable rate mortgages have definitely started coming back. For the last few years after COVID, there wasn't an appetite for them for investors. And the last couple of years, they definitely have started making a comeback, which is great because we're in a little bit higher interest rate environment right now, which is now changing, which is a great thing for everyone. But the adjustable rate mortgages, they're typically about half a point, 3/4 of a point, sometimes a point lower than a normal 30-year fixed. And you're going to be in a fixed product for 5 years, 7 years, or 10 years for those loans. So, I mean, the average person stays in their loan for about 4 years before they refinance or sell or do whatever. So, as long as it's going to be a fixed product for at least 5 years, you're safe. There's really nothing to be worried about that.
With rates where they are today, what are you telling buyers? What are you advising them? Buy now or wait?
Yeah, I mean, it's always about affordability. I mean, if you need to buy a house, you got to buy a house. And thank God the 2.75s are getting out of people's heads for where those rates were, because those were just unrealistic. We're back in normal market trends right now for what rates should be. And as long as you're comfortable, you love the house, you can afford it, jump on it now. I mean, because property values typically go up. Yeah, we have markets where they go down, but they typically go up. You're losing money by waiting. So jump in now, because you can always refinance it at a lower rate, always. So,
absolutely.
Yeah, so buy now.
I work with buyers all the time now, and I'm talking to them, and they're like, well, I want to wait. And the property that they might have bought last year that was $750 is now $8.25.
Yeah,
and
exactly.
Property values are going up where they could have gotten in.
Yeah.
Or not only that, when interest rates, what I don't think they really understand is if interest rates drop, well, now more buyers are actively entering the market.
Oh, yeah.
There's going to be more bidding wars bidding up the properties now.
Yep. No,
where you could have
1000%.
guaranteed and got the property, not in a bidding war for less money, and then you refinance later when the rates go lower.
As long as there's a need for it and you're happy with the payment, you're comfortable with the payment, jump in now. It always gets better.
Absolutely.
Yeah.
Do you see any lending trends or changes in the next year that buyers should be aware of?
I truly think rates should be coming down. The Fed, it's 90% probability the markets are indicating the Fed's going to cut in the next meeting in September, which would be great. That'll help out a lot. So we're a lot of guys I'm talking to saying that we should probably see the rates in the high fives next year or end of this year, which would be great. They open up a lot for a lot of people, and the market a little bit more. Non-qualified mortgages have become more popular as of late. The portfolio loans, you see a lot of banks doing, like the DSCR loans for investors. Bank statement loans are coming back. Those are pretty popular. Just if people are self-employed. Yeah. And the rates on these, they're not your typical. They're your normal 30-year fixed rate pretty much for these products now. So people that are self-employed don't want to have to deal with all that paperwork when you're self-employed. They may lean towards those now. So those have definitely become more popular. Yeah.
I know a lot of business owners or self-employed people that dread the process, but how's the process different for a self-employed person?
Pretty simple now. I mean, as long as you got a borrower that's claiming their income, if you got a self-employed borrower that's writing everything off, it is what it is. But then you got a non-qualified mortgage you can go for, a bank statement loan, or those loans are great for them. But yeah, since we have so much technology now, it used to be, if you had a bunch of different tax returns, a bunch of K-1s, it could be more of a process to getting them pre-approved. But now we just throw it in the system. Technology reads that for us now. So we figure that out pretty quickly. So someone that's self-employed used to be like, I got to wait a couple days for my pre-approval. I can turn those around in an hour now. So really not that big of a difference. Just more documentation we need from a self-employed borrower. That's all. And they know that going in.
Yeah. Are you seeing any refinances now or any cash out refinances?
Oh yeah. A lot of credit card that has been built up in the last few years. I think we're all-time high. Those rates, the average credit card rates in the high 20s. So, even if you had a rate that's 2.75, but you have $50,000 in credit card debt in the 20s, refinance out of that debt if you have the equity in your home. And people have a lot of equity. So see a lot of those. Divorce is always a lot of refinance for divorce, buying the other person out, and then, just home improvements, mainly debt consolidation, stuff like that. Yeah, a lot of refinances going on. And people that were on the 7s and 8s back in October 2023 are now refinancing to low 6s.
Got it.
So you're definitely seeing that move.
What are one thing that lenders wish the borrowers understood better?
The quality of the loan officer that they're working with. You know, you can always, anywhere you go, you can always find a cheaper rate, right? And our rates are extremely competitive. We barely ever lose on it. But you're always going to find something like, at the end of the day, you want to make sure that your loan's going to close. You're going to meet your dates. You don't want to be stressed out, losing your mind because you're talking to an online bank that was an eighth lower than the guy that the referral came from, when he has skin in the game because he's working with the other agent to make sure that it gets to the closing table, all dates are met. Go to an online bank, some guy in Texas, he has no idea. So like, service is, in my opinion, the most important part of it, and having a team put together to do so. You know, and that's what we've always done. I mean, it makes the process that much smoother, the client that much happier, and then it's return clients and referrals from that.
Yeah.
So,
and there's so many bait and switches out there.
Oh God, it's gotten way worse now. It's because of technology too. Like as soon as I pull a credit report, a full credit report, every bank out there that pays for it gets an alert that someone applied for a mortgage, so your phone rings off the hook. And then it's all these bottom feeders that really are just cold calling that have no skin in the game at all. Yeah.
That's insane because they're just selling their information.
Yeah. Yeah.
If you had to give one piece of advice to a first-time home buyer, what would it be?
Like I said earlier, get your financials in order. You know, make sure that you have everything ready. It just makes it that much smoother. So 2 months bank statements, make sure it's all pages for any asset account that you have.
Even if there's a blank fourth page.
Yeah, exactly. We need all pages. Yeah. But yeah, that's have an idea where your credit is prior to calling. Like I said, it's going to be a soft inquiry anyway, so we'll let you know that. And kind of an idea where you want to be monthly payment wise, so we could back into a good figure for you.
What about advice for a homeowner? What would you say would be good advice about somebody thinking about refinancing?
Yeah, so I mean,
when does it make sense?
Yep. So if that's through the roof, right away. I mean, if you got the equity at home, get out of that. Those high 20s will bury you. So you want to get rid of credit card debt if possible. So if that's the case, for sure, do that. Home improvement. And then the rule of thumb that I've always gone off, and that's how I'm alerted by all my clients, refinancing is not expensive. It's way cheaper than a purchase transaction. You know, you could refinance for right around $2,000. If you can make up that $2,000 within a year, it makes sense. As long as you're gonna be in that property for a longer period of time. So rule of thumb, if you make up the closing costs within a year, it makes sense to refinance.
Okay.
Yeah.
Is there a percentage that they would be saving?
Depends on loan amount. Yeah, it depends on loan amount and the rate. Yeah.
Got it. And then wrapping up, where could our listeners find you, see you online, or any website, social media?
I'm all over social media, and I got my cell phone's always the best. Call, text me anytime at 630-290-6251, and I'm always available.
Rate.com/John Noldan.
Yep. Thanks, buddy.
Thank you for being with us.
It's awesome. Thanks for having us.
Have a great one.
All right, man. Thanks.
Big thanks to John Noldan for sharing so much valuable insight today. If you're in the market for a home or thinking about refinancing, I hope this episode gave you some clarity and confidence about the lending process. Remember, the right loan can make all the difference in your home buying journey. You can connect with John Noldan at rate.com/John Noldan or just follow him on social media. I'll drop those links in the show notes for you. And if you enjoyed today's episode, make sure to hit subscribe so you don't miss the next one. We've got more great conversations coming up to help you navigate the world of real estate with ease. Thanks for listening, and until next time, this is Chris Stevens with the Stevens Group Podcast, helping you make smarter moves in real estate.